Today we're going to talk about a very important phenomenon called as carry trade, and this has been something that has been happening for many decades. However, this too creates an imbalance in the global financing system, and it's a very important thing to understand. Imagine a situation where almost all countries that are involved in this have fully convertible currency. What does fully convertible currency means? That means you go to this country, let's say you have dollars, right? You go to Japan and say that I want so many yen at today's exchange rate, and they give you back the money in yen. Now what you do is you have done shopping, you're about to leave, and you have still got some yen that you want to convert back into dollars. Well, they will give it back to you at that day's rate. So it's fully convertible, no questions asked, no cuts or anything of that nature. If you think about this at a higher level, like for example, a country that is having an interest rate which is fairly low, and then there is another country where the interest rates are very, very high, then it creates what is called as arbitrage, that is a differential. Supposing you have a company that is trading in both these countries, that company could borrow money at a very low interest rate from that country which has a lower interest rate, and then take that money, go to the higher interest country and then put it there. Then they can make money all day long on what is called as interest rate arbitrage. And a term that is given for this by the industry is called carry trade. And this carry trade also has created its own set of imbalances, and I'm going to talk to you about how it has been going on for the past couple of decades and what is happening next. So, as always, a small request to please like this video, and if you have not already subscribed to our channel, do subscribe to our channel. Here we go.
I like the treatment here. It's very relaxing and being with the nature.
The most powerful facet that I've experienced here is the power of human touch.
So you have what is explained as a carry trade, and I explained that to you. Borrow money at a low interest currency and then convert it into high interest currency by moving that money into a country that gives you a higher rate of interest and profit from the differential. This part we all know. So who are the key players? Here we see some key players, the interest gap. Well, two countries that have been for a long time keeping their interest rates low are Japan and Switzerland. They typically keep their interest rates very low, and you know that in 2022 end or 2023, United States suddenly started hiking up its rates, and that created a differential. So let's take a look at the interest rates of different countries. Here we go. So Japan was keeping it very low at 0.1%. Switzerland was keeping it at 1.75%. Mexico was keeping it at 11%. And then United States was at 5.5%. This we are talking about during the time of 2022-2023. Now it has come down a little bit. USD is at 4% now. But you get the idea, right? Imagine if we could take money from Japan at 0.1% and then put that money in Mexico and earn 10.9% interest, return on investment, without breaking into sweat. Nice business strategy, right? This is called as carry trade. So what happens? Well, as long as the markets are optimistic, which means the risk is on, what is the risk on effect? So in risk on effect, as you see here, the yen dropped from 100, which is a number, reference number, think of it, and has gone to 88 in a matter of 6 quarters. At the same time, US dollar has gone from 100 to 112. So what happens is it puts a lot of pressure on that currency, which is having a very low interest rate, and in this case it is the yen. These are just representative numbers of how far the yen has shrunk in its currency conversion ratio with respect to the US dollar over a period of 6 quarters. So what happens then is that yen is becoming more expensive versus US dollar, or the exchange rate is not working in favor of people who are going to import in yen because they have to pay more in yen for stuff that they are importing. So what happens is Bank of Japan got really concerned, and what they did was what used to be very, very low, like for example up to March of 2024, the rate was really low. Like for example here, look at this. The VIX was at 14, that is volatility index, and then when Bank of Japan raised its interest rate, it jumped up to 28, a good 100% more. So what that ended up happening was, because this 11% I told you between Mexican peso and Japanese yen suddenly started shrinking, because Japanese yen was no longer at 0.1, it was I think at 2% or something of that nature. So what has happened now is this has forced liquidation of global assets, because you want to sell what you have and not put too much money into this kind of an arbitrage model. And who were the ones who were doing this? If you look at it, for example, first number, US tech equities, that is things like the Max 7 stock. Now you understand where the money for the tech equities is coming from. People are just coolly borrowing from Japan and then putting it in US, and then that money is going into Max 7 stocks. That money is what is keeping, at least one of the reasons why the Max 7 stocks are being kept so high. Then next one, emerging markets corporate bonds. That also has a fairly big percentage, 30%. The big one is of course 45%, which is the US tech equities. Then the third one is commodities futures, that is 15%. I'll come to that in just one second, what commodity futures are. And the fourth one is developed market government bonds, which is 10%. Developed market meaning like Western Europe and so on and so forth. What are commodity futures? Well, what commodity futures are, that before a harvest even begins, like for example, even at the sowing time, somebody may want to make sure that they get a certain amount of money for their produce, whether it is wheat or rice or corn or whatever. They know that if everybody else doesn't have a good produce, then their corn is worth more. And on the other hand, if everybody overproduces, their worth might be less. So they want to ride out the risk and say, okay, I don't care whether I make more or less, I want a guaranteed value. And that's what a commodities futures gives you. So you can see by looking at this where the money that sloshes about in the world is going, and at this point of time it is going in a big way into tech equities. This is also one reason why tech stocks such as the Max 7 stocks are so frothy. It is believed that as Bank of Japan keeps raising interest rates and as United States keeps lowering interest rates, this number is going to start collapsing. Wait and see if that happens or not. That's all I wanted to tell you. Interesting stuff. Thanks for watching. Please like, share, and subscribe to our channel. Don't forget to click on the bell button for notifications. Namaskar.